Welcome everyone. Today's the final investing masterclass, episode 5. It's a huge pleasure to obviously do this recurring series where I have learned so much about just building up a portfolio from scratch, learning everything step by step with the help of our master teacher, Vince Scully. Today is a bit different. We are in the same city, but we are both joining virtually in our respective studios, and we're super thrilled to bring this last episode to you. Let me do my introduction again. I am Himangi. I'm from the marketing team at Sharesight. If you don't know about Sharesight, we are Australia's #1 portfolio tracker. We help you check your investments in one place with award-winning performance tracking, dividend tracking, and tax reporting. It's been a lovely rain-free day here in Sydney, obviously after a massive week of just pouring rain. It's a great way to end this day with, obviously, we're going to touch portfolio construction today. We're obviously joined by Vince Scully, who's the CEO of Life Sherpa, and he, as we know, is among Australia's top 50 most influential financial advisors. Since this is the last episode, we have some surprises up for you. We have a little chat box up here in the corner. We love for this to be an interactive session. Please do pop in your thoughts below. We'll try to address them as soon as possible. We also have a Q&A section. I really highly encourage you to put in your questions in there, because the best question might probably just win a surprise prize at the end. You might also get 2 copies. 2 lucky people can also get copies of Vince's book, Live the Life the Way You Want with the Money You Have.
I'll even sign them.
Yes, and obviously that is a great deal. So the best question will win. So, I mean, keep your questions popping in. And without further ado, let's look at portfolio construction. Over to you, Vince.
Thank you for that, Himangi. And I guess I should start by acknowledging the Camaragal people, the earliest recorded inhabitants of the land that today we call North Sydney. So, as Himangi said, this is the 5th and final episode of our portfolio construction masterclass, and we started 4 episodes ago with an introduction to the 5 asset classes, or the 5 Bs as I call them. So this is going to be important going forward, so I'll just very quickly revise that little piece of work. So the 5 Bs are on the defensive side, so that's assets that are capable of smoothing out the ups and downs of your portfolio, so they would call those defensive assets. And the 3 Bs in the defensive category are bills, which is cash, bonds, which is really loans to governments and companies, and bullion, which is short for commodities. And in the case for most retail investors, that will be gold. On the growth side, that's assets that are capable of delivering a return above and beyond inflation. The 2 Bs there are bricks and businesses. Businesses are shares or stocks, depending on where you come from, and bricks are really real assets such as infrastructure and real estate. And by combining those 5 building blocks into a portfolio, we can create a return profile that is better than the sum of its parts. And so in episode 2, we then did a deep dive into the growth assets, so bricks and businesses, and that was a very popular episode, which I guess is symptomatic of the market's return over the last decade or so. The 3rd episode, we deep dived into the defensive side, focusing primarily on gold and bonds. And in episode 4, which was the last one, we looked at thematic investing, or in core and satellite investing. So this one today really is trying to pull all of that together and look at how we should put those 5 building blocks together to build a portfolio that is capable of delivering the return that we need to achieve our goals and aligns with our risk profile and investment horizon. So with that said, I should kickstart the slides. So, I mean, one of the negatives, I guess, of investing becoming so accessible is that there is just so much content on the internet, whether that's on YouTube or Facebook or Instagram or TikTok, especially TikTok, that some of the nuances gets lost. And as humans, we crave simple solutions. So some of the most successful content in terms of clicks or views is simplified content. So content that says, do this, get this result. And in practice, when it comes to financial, personal finance stuff and health stuff, for example, the simple answer might seem attractive to our human brains, but it's not necessarily the right answer. So I'm always reminded of the words of H.L. Mencken, who said that there's always a well-known solution to every human problem that's neat, plausible, and wrong. And I want to use this to highlight where those fallacies have popped in, and very popular on Reddit in particular. And so let's try and bust a few myths and look at what a proper portfolio might look like. So those of you who spent enough time on the internet will probably be familiar with a couple of these suggestions. So my good friend J.L. Collins has written a book called A Simple Path to Wealth, and his philosophy is best summarised as VTSAX and chill. So VTSAX for us Australians is VTI, that's the Vanguard Total US Share Market Fund. And JL's approach to life was to recommend that his daughter simply punt everything on VTI and get on with her life. So it's called A Simple Path to Wealth, not the Optimal Path to Wealth. So that's a good one. Lars Kroyer goes a little step closer to the truth. Now, Lars is a former hedge fund manager, so you might expect that he might be a little bit more educated. So Lars says, well, what you need to do is invest in a global equities fund, and however much bonds you need to allow yourself to sleep at night, which is closer to the truth, but would work in an ideal world where we didn't have currencies, we didn't have difference in taxes, we didn't have differences in regulatory affairs, and everyone was playing the same game. And of course, everyone in the market isn't playing the same game. And then, of course, our tech bro friends on Reddit or in the media will say, well, look, all you need is VAS, Vanguard Australian Share Fund, which is Australian large cap equities, VTS, which is our US total market fund, and VU being a rest of the world fund. What you'll notice there is that is 100% equities. And of course, that is an attractive feeling for anyone whose investment experience started in the last decade or so. So that's sort of anyone under 40 will have no direct personal experience of a serious downturn. We'll look at a couple of those in the course of tonight's presentation. The closest most people will have got to that was the COVID, the pandemic downturn at the beginning of 2020, but it was very short-lived and wasn't particularly deep for very long. So the cult of equities is alive and well and living in Reddit. So this is the simple solution. And so what I'm hopefully going to show you tonight is something that is readily graspable, but avoid some of the gross oversimplifications of these approaches. So with that said, let's get into it. And the thing that all of these guys miss out on is thinking about risk. And traditionally, we might have thought about risk as the risk of losing my money. So if I invest in company company X, there is a risk that company X might go bankrupt and my investment could be worth zero. And there's certainly a good track record of major Australian companies and companies around the world failing and their shares being worthless. So if you go back to 2008, there's a long list of ASX 200 or ASX 300 companies that are no longer with us. I think of City Pacific, MFS, ABC Childcare, Alco, Babcock and Brown. So there's a long list of companies that Virgin Airlines, Harris Scarf. There is a fairly long list of companies that do go, and that's largely now why investing in individual companies does give rise to that risk. But if you invest in a broad portfolio of companies, the odds of your investment going to zero is vanishingly small. So risk really, to me, is, when you think about it a little more deeply, is really about what is the risk of me achieving my goals? So the risk of not achieving my goals, more importantly. That risk is usually something where you think about on the downside. That is, what if I fall short? Nobody cares too much about risk if you end up with too much money. So the way we measure that, or the closest proxy we have for that in the financial markets, at least in terms of listed companies, is volatility. And volatility measures the wiggliness of the line. It's the dispersion of returns. So how different from the average is my return going to be? And we use a measure called volatility to measure that. For those of you who can remember your high school maths, it's technically the standard deviation of the returns. And the standard deviation measures what proportion of the times your return will be within a fixed difference to the mean or the average. So one standard deviation either side of the mean will encompass about 2/3 of all potential outcomes. So we use volatility as a proxy or a tool to help us measure differences in volatility. And many people will say, and if we have a look at that, when you look at where you can get your returns, if you plot any investment on a graph which shows return on the Y or vertical axis and volatility on the horizontal or X axis, the top left-hand side of the graph being the very low volatility, very high returns, is simply not feasible. That if anyone is trying to tell you you can have a very low volatility investment or very low risk investment with a very high return, they are either deluded, lying, or trying to scam you. And so that top left-hand corner isn't particularly feasible. And the bottom right-hand corner, where you take very high levels of volatility for very low returns, that's somewhere you really don't want to be playing because you're not getting reward for the risk. So there is a wedge in the middle there where as volatility rises, you should expect to get a higher return. And so by playing in that middle piece, but as far to the top left as you can get, that's the goal of creating a portfolio. So when we look at returns, we go, well, what is my risk-adjusted return? That is, if I'm taking more risk, am I getting more return? For every extra unit of risk I take, am I getting an extra unit of return? And that's a concept where what you really want to be making sure is that whatever risks you are taking, you are going to be or you expect to be earning a return commensurate with that risk. And one of the retorts that you get from the tech bros on Reddit is that you can't eat risk-adjusted returns. That is, you should look for higher returns and not necessarily higher risk-adjusted returns. And whilst that statement on its own is true, that's not what actually ends up in your pocket. The statement hides the reality of how it plays through into our psychology. The other response that you're going to get when people try to argue that, well, volatility isn't a loss, that just because the price went up today or down today, that if it went down today and you don't sell, you haven't actually realized the loss. So Nick Murray, who's probably, he's certainly been around longer than I have, and he would be thought of largely as the financial advisor's financial advisor. He's been around a very long time. And Nick, in his book, Around the Year with Nick Murray, which is a lesson for every day of the year that every financial advisor should read in the morning. Nick says that volatility isn't loss, and this is also a truism, but it's the impact it has on our psychology that matters. So Nick says that while emotionally painful, adverse movements in asset prices only hurt me if I sell. And again, that's a truism. So long as I can hold through the bottom, price movements have limited bearing on my life. And he summarizes this in a little aphorism, which he says that the decline is temporary, the advance is inevitable. And that's why he's written a book called The Inevitable, Simple Wealth, Inevitable Wealth. And again, all of those statements on their own is true, but it ignores the impact that it has on our human psychology. So if we were all machines or robots, Nick is absolutely right. And in some ways, this is a good way of thinking about it, that volatility only turns into a loss if you sell. And so the ability to trade through that and stay the course is actually its key. And what we find is that taking more risk than you can stomach might deliver a higher expected return, but that return won't turn up in your pocket if you can't stay the course. I think that's the message here. So the way I'd rather think about volatility is not the fact that this graph is wiggly or that it goes up and down, but volatility is in practice a measure of the variability of returns. That is, the more volatile the investment, the greater the range of returns you can expect to see over time. Now, the longer you're invested, the narrower that spread gets. So if we look at the Australian stock market, its worst years probably minus 40. Its top years probably being plus 30, plus 40. But when you look at it over decade type range, decade-long periods, that gap narrows very significantly. So the direct impact on individual portfolios or individual people, well, you need to think that for every portfolio there's a person or persons behind it. And it's this human instinct that matters here. So the greater the volatility, the greater the variability of the outcome, and hence the potentially lower probability of achieving your goal, all other things being equal. So the key here is to work out what return you need to achieve and how can I get that return at the lowest possible volatility, and do I have the stomach to stay the course through that volatility? If the answer to that question is no, I don't have the stomach to do that. I either have to accept that my goal could very well take longer to achieve, or I have to set aside more of today's money to fund tomorrow or next year's goal. That there are three levers we can pull when it comes to investing. It's how much we set aside, how long we're prepared to wait, and what return we can expect. And you can pick any two, and then the third falls out. So we'll see mathematically what this looks like later on, but it is important that you go, well, if I'm looking long term, I need to have as much growth in my portfolio as I can, as I need to achieve the goal I need, and I then need enough defensive assets to allow me to sleep at night and to reduce that variability. And that's what we're going to get onto. So that brings me back to the missing piece in Jail's or Lars's book or the Reddit bros, is that you can only eat returns that actually make it to your pocket. And staying the course is critical. And staying the course is a function of aligning the risk in your portfolio with your risk tolerance and your risk capacity and your ability to recover from it, and the level you need to achieve your goals. There's also a whole bunch of mechanical stuff that needs to be done to keep that on track. But the point here being that the market will deliver returns. So it doesn't really matter whether, so the Vanguard Australian Share Funds doesn't know whether someone picked it by throwing a dart at the Fin Review, or they received professional advice saying, you should have 22% in Australian large cap shares, or you chose it from having read some of these media players. So it will do what it does, and it will do what the market does. What portfolio construction and the advice that goes with that achieves is ensuring that that return ends up in your pocket. And that's what really makes the difference between an okay portfolio and a optimized portfolio. So let's look at that in practice. And so when it comes to constructing a portfolio, the first decision is my asset allocation, which, as we mentioned in episode 1 of this, is how much of my money I allocate to each of the 5 Bs. And within those Bs, which, so within my businesses or stocks part of that, how much of that I allocate to Australian shares, how much I allocate to overseas shares, how much I allocate to big shares, how much I allocate to small shares, how much I allocate to growth shares, how much I allocate to value shares. So all of those things we call factors. So the size factor, the growth factor, the value factor. That's what drives returns. When it comes to bonds, the 2 factors that matter are duration, so how long a bond is, how long it is to go to maturity, and the credit worthiness of the counterparty. And so by allocating to the 5 Bs, and within those 5 Bs, allocating among my factors, markets, and regions, that's what drives the vast bulk of my returns. The proportion of your Australian large cap shares that's allocated to Telstra compared to National Australia Bank matters very little over the long term. And in general, the higher the allocation to growth assets leads to higher expected returns. And but as I've just been through in terms of how you allocate that, the statement that this portfolio is an 80% growth portfolio doesn't reveal the reality. It's a very good guide, but it doesn't necessarily tell you the full story. And we see this play out in the Australian superannuation market, for example. So this is data from APRA. It looks at 8-year returns for all of the public offer My Super funds, and you'll see a general up and to the right trend here. So as you move across to the right of this graph, you're adding more and more growth assets, and the return is generally trending up. So the range of returns within those asset allocations is smaller than the difference between one range and another. There is a bit more noise in this than you would see in non-super or overseas markets, and that's because there's a fair bit of difference in how the super funds categorize some assets. So APRA, for example, allows a super fund to classify unlisted real estate or unlisted infrastructure as partly defensive, even though it's largely a growth style asset. So this led to fairly absurd results that an investment in Brisbane Airport, which was unlisted, got counted 50% defensive, 50% growth, whereas in UniSuper's 19% investment in Sydney Airport, which was listed, was counted as 100% growth assets, despite the fact that Sydney Airport was a mature airport, not with fairly stable traffic, not requiring lots of capital expenditure, whereas Brisbane Airport was very much a leisure airport. Lots of capital expenditure needed to maintain the growth, and without the stability of the Sydney Airport. But the day that the consortium of super funds bought Sydney Airport private, so effectively bought the remaining shares from the public market and turned it private, suddenly 50% of it became defensive. So that's the noise you see in this. If you took those sort of things out, you'd find a much narrower dispersion of returns within the category. But this is really just demonstrating that much of your returns comes from the asset allocation. And the other thing that asset allocation does for you is to, as I said, help you stay the course. So this is looking back to 2008. So the left-hand margin of this is November 2007, when the Australian share market peaked. And then really sort of declined slowly through the end of 2007, beginning of 2008, and fell off a cliff in September 2008 when Lehman Brothers collapsed. So the teal line at the bottom is global equities. That's a 50-50-50 global Australian equity portfolio. And you can see that it dropped by 40% by the time it hit its nadir in 2009-10. And it took until 2013 before it got back to its 2007 peak. But whilst that was declining, the blue spiky line at the top is gold. So you can see that gold peaked at about up 50% as the share markets fell, and the bond market went on a steady increase as governments around the world cut interest rates to deal with the fallout of the GFC. So a mixture of bonds, gold, and shares here would have given you a much smoother line. And we saw a similar thing play out in 2020 during the pandemic decline. So February 2020, the Australian market peaked. And in the sort of March, April period, it plummeted very rapidly and took just over a year to get back to where it was. Whereas bonds were pretty stable through that period, and gold rose in the early parts of it. Much of that reflects, or a fair chunk of that reflects, the fall in the Australian dollar in that period. But again, what you're seeing here is that gold and bonds moving in the opposite direction to equities, which delivers a bit of a smoothing to your returns. And that's why diversification matters. You're not always going to see this perfect opposite movement. Certainly 2022 was one of the few times when we've seen synchronized bond and equity downturns. So it's not 100% reliable, but looking at the past does show us what these correlations look like. So before we now try and apply these learnings to actually building a portfolio, it's a good time now for Hamangi to show us a little bit about how you might use Sharesight to analyze your portfolio to see how diversified you are or are not, and what those contributions to returns might be. Hamangi.
Thank you, Vince. Just want to make sure I am audible. Yes?
Yes, I can hear you.
Yes, that's amazing. It's lovely to see everyone just chatting about in the chat box. All right, so, I mean, let's recap all of the 5 Bs for us once more. Now, when it comes to asset allocation, let me just quickly get my screen share on. And that you can see is a sample portfolio that we put together looking at all the 5 Bs that Vince looked at, and then recapping them all into this little portfolio. Just to note that this is a sample portfolio, and none of this should be considered as financial advice from my end. This is purely a sample portfolio that is there for exemplary purposes. Right. Now,
so this might be a good moment to point out that, notwithstanding that I do have a license to provide financial advice, nothing here should be considered personal advice. I don't know anything about anybody who's on here apart from their email address and their name. So nothing we say can take your personal circumstances into account. And of course, you should read the PDS, which is not just a fat thing in front of the application form. It is actually important information for investing. And retail investors should also consider the target market determination.
Thank you, Vince, for that clarification, which was really important. Let's quickly have a look at, now here's a sample portfolio in front of us where we've looked at all the 5 Bs. Now, with your asset allocation strategy, that is obviously different to every individual. You might want to break it down and have a look at what percentage of your portfolio is made up of the different Bs. Now, I have a bunch of holdings across multiple ETFs across different asset classes. Now, if I want to have a look at what does my portfolio look like graphically in terms of the asset allocation, is it matching to the visualization that I have in front of me? For that, we have 2 helpful reports. Let's start with the performance report. Now, I want to have a look at all the assets across that I have, and I have a custom grouping assigned to all my assets. Sharesight lets you attach groupings by your own investment strategies. So now I have made my personal grouping, as you can see, with Aussie shares, global shares, bonds, cash, commodities, and real assets. Now, this report essentially is showing me that from the date that I bought these holdings to date, what is the percentage growth or decline that I have received in each holding. And obviously the size of the boxes determine the percentage or the weightage each of these assets have to my portfolio. Now, as you can see, I have the most amount in Aussie, just shares in general. You can see the improvement or the positive improvement in my holdings over time. Now, if I want to see the way it's been spread out, how much of my portfolio is assigned to each of the 5 Bs, and what is the overall contribution to my portfolio's diversity? For that, I'll have a look at my diversity report, which can again be across investment sectors, markets, industries. But because I still want to go by my grouping and check if my asset allocation is on track, I will continue to group it by my grouping and then run a report. Now, this is where it gets interesting, right? Here is where I can visualize literally all the bits of my portfolio. So as you can see, we've got Aussie shares, global shares, a little bit of bonds in there with some cash and real assets. So all the 5 Bs that Vince has covered with on all the last 4 episodes, I've essentially allocated them in my investments with the way that I wanted to see them. And this report is actually giving me a good snapshot of where I am with my investment strategy. Now, I can decide here if I want to continue this way or if I want to keep diversifying. It's really up to everyone's individual investment journey. Now, again, this was just a sample of what you can do and how you can play around with the reports in Sharesight. This report that you just saw, the diversity report, along with the exposure report, is available on Sharesight's investor, expert, and Sharesight professional plans. So you can have a go at it once, obviously, we've learned a bit more about portfolio construction. So now that we've seen, how these 5 Bs are visualized into my portfolio, let's actually deep dive into how we got to creating this. So back to you, Vince.
Thanks, Amangi. I've just been flicking through some of the questions that are coming through thick and fast whilst you were doing that. Obviously listening very attentively, but also flicking through the chat. And there are quite a few people asking questions which sort of amount to the, if some is good, why isn't more better? Quoting now, or paraphrasing, should I say. Diversification is a strategy to offset behavioral risk caused by high volatility. If you can stay the course and not sell during downturns, why not just invest in the S&P 500 and NASDAQ 100? And there's a number of variations in that theme. And when we go through the next stage, we will see why, when it comes to investing, if some is good, more is not necessarily better. And it's to do with the way these categories behave relative to each other. So sometimes the sum of 2 investments can actually give you a higher return and lower volatility than either of the components. That's the science behind portfolio construction. It's not about grasping a random handful of ETFs and hoping for the best. So let's crack on. So here's a bit of a simple illustration of that point. So back to our return volatility chart. So what we've got here is Australian large cap equities. We sort of sit, and this is a 20-year scattered outcome. So it's looking at the realized return over 20 years. That is, if you invested at a lump sum at the beginning of the 20-year period, in this case, 1st of April 2004, and held to the end and reinvested all your dividends when they happened. And this shows that Australian equities delivered a return of just over 8% in that period and showed a volatility of 13 to 14. And so what that means is that if 8 is the mean, then you would expect a return of 8 plus or minus 14 in 2/3 of the time. When you look at global equities, they delivered a marginally higher return and lower volatility. So you moved up and to the left, and taking that point in the chat, we said, well, if international equities gave me a higher return at lower volatility compared to Australian shares. Why wouldn't I go all in on international shares? And that's broadly Lars's approach in the book. And the answer to that question is, well, when you put a mixture of these two together, the lack of perfect correlation shows that if I take half of each, I actually get a higher return, very marginally, than either of them, and a marginally lower volatility. And that sort of effect plays out across a lot of the other asset classes. And we'll see the impact of that very shortly. So just looking at what happened there. So we took two asset classes and combined half and half, and we ended up with a weighted average or merged return that was slightly lower volatility and slightly higher returns. So in that case, you get a better return by mixing a lower return, higher volatility Australian equity portion with a lower volatility, higher return global equities, and you end up with a merged better return. And the secret to building robust portfolios that maximize returns for any given level of volatility you're prepared to accept is the key to modern portfolio theory. And this stuff is relatively new in the history of investing. Much of the modern portfolio construction theory has been developed in my lifetime. The seminal paper on a lot of this stuff, the Farmer-French factor model, was released in my high school days. So this is, it's not surprising that some of this stuff is taken a while for the financial services sector to admit to and accept, because there is a whole range of people whose jobs depends on people not accepting this stuff. And so that's the start of this. So that's just taking two categories, two different types of equities. So the same B, the business's port, but taking two subsets of this and just looking at two markets, global, Australia. And so we can see a similar sort of effect happen. So when I plot all of the other asset classes on the same chart, you can see that small cap shares on the extreme top right, they deliver higher expected returns, but at much higher volatility. Gold, despite its defensive nature, and its defensive nature largely comes from its opposite correlation to equities. And we saw that in the 2008 and 2020 graphs, that whilst it is relatively volatile and delivers generally quite high returns, at least certainly over the last 30 years or so, it doesn't exhibit the low volatility, low returns you might expect from a defensive asset. So looking at the bottom left-hand corner there, we see bonds where we'd expect them to be. So low volatility, relatively low returns. And over the right-hand side there, just below the international equities, we see infrastructure and real estate across to the right of that level. And then we've got emerging markets with a lower return and slightly lower volatility compared to Australian equities. Now, that's a bit of an anomaly. That result doesn't seem to stack up with what the theory would suggest. That you would think that emerging markets, higher growth, higher risk, higher volatility, And that's not actually what we've seen over the last 20 years or so. The second 10 of that 20, we see a bit more. But what we've seen is low growth in some of the bigger sectors of that, and particularly poor returns in the so-called BRIC countries, Brazil, Russia, India, China. China in particular has delivered very poor returns over the last 5 years or so. So that is a bit of an anomaly, and I'm sure there will be many PhD theses written on why that is the case. So sometimes the theory doesn't show up in practice, but you would expect that over a long enough period, that will correct itself. So as you can see, these are all over the place. And focus back on our 50-50 Australian international equities, the grey blob. So that's 100% growth. It's 100% equities. And I'm about to show you what a portfolio consisting of those items with some of the other Bs mixed in to give a 90% growth portfolio. That is, 90% of the assets are in the bricks and businesses, and 10% is in the bills, bonds, and bullion section. And what you see is that it actually gives you a higher return than 100% equities at lower volatility. And that is why the if some is good, more must be better school of thinking doesn't quite work when it comes to portfolio construction. So why would you expect something that contains stuff that has exhibited generally higher volatility, because most of those asset classes are to the right of our equities, certainly gold, small cap, real estate are both to the right, and certainly much of those are at lower returns. But when I mix them together, I actually end up with a higher overall return and a lower overall volatility. And so somebody whose tolerance for risk set them at able to accept a 10% annual volatility can actually generate a higher return and ensure that it ends up in their pocket than somebody who took the higher risk of 100% equity portfolio. And that's the secret sauce in building a portfolio. Now, that's a 90%. Well, what happens if we drop it to 80% by adding in some more defensive? Well, we expect it to move down and to the left. So we give up some return in order to gain lower volatility. And adding some more then drops it down. So what we're seeing there is that our in order to achieve a reduction in volatility, we've had to give up some return. But on the first step, moving from the 100% equities, 100% growth, we actually gained both higher return and lower volatility. But if your tolerance for risk is in the 7s, then you need to be in the what we call our balanced 70 portfolio. And this is how you do. So in order to do this, you need to have the data to measure historical returns and to measure historical volatility and to measure the cross-correlation between these sectors. And so when you see the past performance as an indication of future performance, There's a reason why the regulator makes us say that, and that is last year's return or the year before's return doesn't give us any particular information about next year's return. But by studying the past, we can look at how these things interact with each other, how they behave in various market conditions, and stack the deck in our favour. None of this is guaranteed. So certainly if you looked at 2022, when we had simultaneous double-digit declines in both global equities and global bonds, that wouldn't have been predicted by the theory. So you do get outliers, but what this is about is stacking the deck in your favour. I mean, Charlie Ellis wrote a book called The Loser's Game, and that was based on an earlier piece of work around tennis, and he distinguished the original book that Charlie based the theory on was that the game of tennis is at the professional level, it's about forcing your opponent to make an error, and that the winner is the one who makes the better play. At the amateur level, it's a game of who makes the least mistakes. And that's why I think Charlie took that thought and said, well, that's actually very true of investing, that the secret to successful investing is not necessarily being the guru, being the handful of very accomplished, skillful investors. It's actually about, in the most part, avoiding unforced errors. And the human brain is not particularly good at doing that. And so as humans, we are predisposed to taking action. We are predisposed to seeking out dopamine hits. And so we saw this in the numbers in the thematic investing episode last month, where we see that most of these thematic funds, which are great marketing stories, so it's very easy to accept that the blockchain or crypto or artificial intelligence or the metaverse is a idea whose time has come, and therefore that trend is something I should invest in. And the truth is that investors pile into them when it's too late. And we saw this with the Tesla chart that I put up the last time, that the vast bulk of the excess return for Tesla shareholders happened before it was admitted to the S&P 500, and hence before it was part of the mainstream. So humans are not particularly good at these things. And so by applying this sort of more scientific framework and doing the analysis, you actually end up with a better return. So my job as an advisor is not to predict what the market's going to do. It's not to say that I can pick the best funds. My job is to put together portfolios that ensure that those market returns end up in the pockets of Life Sherpa members. And so anyone who tells you that I can get you a better return a higher return than the next guy, because I can predict the market, is either delusional or lying or trying to scam you. The key skill of a portfolio constructor or an advisor is to construct a portfolio that will fit with your behavior and give you the best chance of achieving your goals as possible. So it's about stacking the deck in your favor, and it's about protecting your portfolio from yourself. I think it was Peter Lynch who said that the investors worst enemy is looking at them in the mirror. And if you've read any of the behavioural investing papers that come out in the last decade or so, that seems to be extremely true. So that's the theory there. So what does that actually mean for us in practice? And what we're saying is that lower volatility leads to lower variability in future outcomes. Makes it easier to stay the course and gives you a greater probability of achieving your goals. And for the most part, financial planning is about husbanding scarce or finite resources to achieving the goals that we've set for ourselves. And what do I mean by all of that? Now, this is a bit of a complex graph. So here we are comparing our 100% equities portfolio, which we saw on the graph, and then looking at the spread of returns over time. So this is looking at a 20-year period. So if you look at the outermost blue and red lines, that is the spread of returns you might expect in a 100% equities portfolio. And that's not necessarily that 20 years shown on the previous page, but this is what, when I simulate tens of thousands of 20-year periods based on the volatility and expected return, I get a range of returns. So that in the first year, I could get plus 50% or I could get minus 30%. Over time, as the returns revert to the mean, I end up in a period where I could get between 17% and 3%, or thereabouts 4%. Whereas if I look at my diversified 80% portfolio, 90% portfolio here, the expected return, being the 50% probability, is broadly the same. It's hard to tell the two lines apart, but the spread between the best and worst is actually the coloured in teal portion of this graph. So that is a narrower spread. So I give up some of the extreme upside. So the 1 to 5% probability things, I'm giving up that upside. And that's a reason why you might consider a 100% equities portfolio, that there is some top side that you are giving up by lowering the volatility. But you also lift the lowest portion. So you gain on the bottom side. So volatility works two ways, that you can't have volatility on the upside without accepting volatility on the downside. And so having lower volatility narrows the range of outcomes. Now, so what that means is that you have a greater chance of achieving your goal as long as that goal is somewhere in the middle. If your goal required a return at the very top end of those return outcomes, then you've got a very low probability of achieving them, perhaps 1 to 5%, and that probability reduces to 0 on the 90% portfolio. On the other hand, you gain some protection on the downside. But the expected return, that is the 50% tile return, is broadly the same. And that flows through directly to the ability to achieve your goals. So here we've taken a goal. So this investor's got $100,000 and they need $387,000 in 20 years' time. That's what their goal achieves. If they wanted to put in less, they'd have to look for a higher return or wait for longer. So here, in order to achieve that, you need to realize a 7% annualized return. And so this investor needs to choose between investing in our 100% equity portfolio or the slightly higher return, lower volatility, 90% portfolio. And we look at the probability of them achieving that goal. So that portfolio's got an expected return potentially in the 10s, 8 to 10, and he needs 7. So what you would expect is that there are some scenarios, a portion of the 20-year periods, in which the goal will be realized more quickly than 20 years. And so the dark blue line is the 100% equities portfolio. And what you see there is that it's got a higher probability in the very near term, that there is a possibility that you might get a few cracker years in the early period. So the probability of achieving this goal, that's a 20-year goal in, say, 6 years, is not zero, and it is higher for the 100% more volatile portfolio because there is a small probability that you get an outsized return. And when we get to the 40-50% probability, you get this crossover effect where the steadier returns of the lower volatility portfolio start to pay off. And what you find is that you get to the 100% probability years earlier with the lower volatility portfolio. And that's why you should be looking for a return for volatility. Now, you have to decide, how much return I'm prepared to give up to get that lower volatility. And so starting with this high growth 90 portfolio that I've got here, that doesn't require you to give up any return to get the lower volatility. So by mixing in those other asset classes, you increase the probability of achieving your goal over time, and you don't give up any return. That is the secret sauce of financial investing, and that's why 100% equities is rarely the right answer. But when you look at the last decade, so for most investors, the sort of, the tech bros on Reddit, for example, they went around in 87, 91, 99, 74, 82. And so the last decade, certainly the post-GFC period from, say, 2010 onwards, has been a period characterized by cheap, free, easy money from central banks easing to avoid the negatives and being afraid to the negatives of the 2008 situation and being a bit afraid to pull back on it. And so if your experience of investing is since 2010, which is broadly anyone under 40, it is very tempting to look at that period and go, equity's good, bonds bad, and feel like you can tolerate the volatility of 100% equities portfolio. The cult of equities, as it's referred to in markets. And it's not till you actually live through one of these periods. My first experience as a young graduate was the early 80s collapse. So I've been through a few. It's not till you've been through one of those and you've lost a lot of money do you really learn this lesson. For me, Japan was my big savior in 1987. The fact that when in 1987, October 1987, the global share markets fell massively. Japan didn't fall for a couple of years. And back then, Japan was the thing. And so there were Japan funds being launched every week. And Japan made up something like 40% of the MSCI global market back then. And it didn't collapse till 91. So that was the thing that saved my margin calls in 1987. And that is a lesson that you never forget. And so, I obviously wasn't following this sort of theory at the time. I was getting my investment tips from the Financial Times and the Wall Street Journal. And it wasn't until much later that I started to learn and apply these techniques. And so that's a lesson that needs to be learned. Now, I'm not wishing a massive market decline on anybody, but it is the key to successful investing, is to understand why you're doing it and understand the mechanics of putting a portfolio together. So a portfolio is more than, the sum is greater than, or the whole is greater than the sum of its parts in most cases. And I spend a lot of time on Reddit and on Facebook and or Twitter, and you see a huge amount of obsession about management costs. So I see these arguments about whether I should invest in IVV, the S&P 500 BlackRock fund, or the Vanguard fund, and the difference is 1 or 2 basis points. And that's just missing the wood for the trees. That broad-based indexed funds now have fees approaching 0. And that's not a particularly useful way of deciding what to invest in. Some asset classes are more expensive to manage than others. So large cap equities can be managed for close to 0, and 8 basis points is not a materially different to 0. When you move on to things like real estate infrastructure, you're probably looking at 0.4, 0.5% as a cost of management. That's a function of the asset class, and small caps get even higher. But that's a function of the asset class. So when you're trying to compare any of these things, you've got to look at what you're comparing things to. And Peter Thornhill, who's been around a lot longer than I have, and he doesn't have as much hair as I do, but he makes the point that he always asks the question, compared to what? So if anyone says, NDQ has been a great investment, the question is, compared to what? And are you really comparing like with like? And so with that, maybe Hamangi, if you can read out some of our viewers' questions.
Right. Since we're running out of time, I'll just quickly go through a few. Do the Australian equities performance include dividends or market performance only?
No, I always look at total return. So all of those returns I've looked at are total return after fees, before tax. So depending on your tax rate, the after-tax return from an Australian investment might be higher due to franking credits. So the important thing is to look at total returns. It can be very deceptive. Like the normal thing that you see on the news every night is the price return. And so when you look at the All Ords of the S&P 500, that's a price return. And in Australia, about half the return comes from dividends. So if you just look at price, you get a very misleading view of the world, and even more so in Japan. You know, if you look at the Japanese return since '91, it only just got back to where it was this year. But if you add back in the dividends, it was a much better answer. So you've got to look at total return after fees, and ideally after tax. But that's much harder to compare because everyone's got a different tax rate.
Now we have one more from Linda Cheng. Appreciate you can share insight on how to analyze company financial statements to extract relevant information for investment purposes, because oftentimes strong financial statements and balance sheets do not translate into good investment.
Now that is a gem. It is absolutely true that great companies do not always make great investments, nor do great investment theses make great investments. All good investments need to have a combination of fundamentals and a price. So a great company is only a good investment at the right price. And that's where a lot of analysis comes in. So a value investor, like a Warren Buffett or a Peter Lynch, would look at it and go, well, what is the fundamental value of this business, and can I buy it at a price that gives me enough margin of error? This is people spend 5 years at university learning stuff, analysing financial statements to try and turn that into an investment thesis is not simple. If you want to get at the heart of this, there's a US professor called Damodaran, I think. But he's got a really good YouTube series on that company valuation. He's got a particularly good one on series on Tesla. So I can't remember his name precisely, but he's of Indian extraction, US professor. Damodaran, I think is his name. But if you Google Tesla valuation on YouTube, I'm sure you'll find it. So.
All right. Oh, sorry, I didn't mean to interrupt. Oh,
that was it.
No, we've got one more interesting one from Luke Smith. It says, read an article from Morningstar today suggesting not to invest in bond ETFs. If you invest in stock ETFs only with a 30-year time frame, will the returns outperform the volatility if you don't invest in bonds? Do you want me to read it again?
Yeah, I mean, I think I've seen the paper, and there is some recent research, and the guys on the Rational Reminder podcast did it really good. There's a Canadian academic who's just put out a paper which suggests that the very long-term correlations don't quite line up with the short-term correlations. That what the research seems to be showing is that over 30 years or 40 years, there's a closer correlation between bonds and equities than over 5, 10, or 20 years. And so for a long-term retirement portfolio, more equities might be better. The paper that I read, I think is confusing a few things. That the conclusion that was drawn from that, which I think is probably in the Morningstar thing that our questioner was asking, is that because you have a higher expected return from equities, albeit with a wider range, you would expect that over a long enough period that it would give you a higher return than cash, for example. And that's why we invest in growth assets. I think the jury's still out on this, and I think the problem being that as humans, we are not conditioned to dealing with 30 and 40-year time horizons. We want to do something today to achieve a result today. And I think whilst the academic research might be pointing towards longer-term differences in correlations, I think it'd be very dangerous to apply that directly to a retail DIY portfolio.
All right. Do we have time for one more? Do you think, Vince? Do we have time for one more?
There was one other one that there was a question about gold in here.
Yeah, I read that.
Yeah. Sorry, there is one other point on Luke's question, that the difference in behavior between an actual bond and a bond ETF is important. If you buy a bond on issue and hold it to maturity, you're going to get your money back, and you'll get a yield along the way, which you know at the outset. When you buy a portfolio of bonds, you're obviously not getting that, because you're buying a pool at today's money, some of which may be worth more or less than the face value. And so working out what you've got is not that easy, and it doesn't give you the same analysis. And many of the indexes that these ETFs follow are heavily weighted to the short end, where the risk return doesn't line up because banks are sort of forced to hold them. And so the excess returns competed away. So the benefits would lean towards holding individual bonds and managing them, but that's a difficult exercise to do with small amounts of money. If you're investing millions of dollars, that's certainly possible. It does take a bit of time and a bit of analysis, and whether you're going to get the right spreads when you're going to buy it is, it's a bit of a murkier market if you're not in there every day. So for most people, we will need to look at ETFs to hold our bonds, or at least funds, not necessarily index funds, but funds. And there's certainly a lot of evidence that active management can add significant value. I do notice that someone, Alexander in the chat, has identified Aswath Damodoran. So I was close, but my fading memories obviously failed me on that one. So if you want to look at some good tutorials on company valuation, go and look at Aswath Damodoran on YouTube. Well worth the price of admission.
Alexander's also helped us locate the gold question that you were,
so that's a great question.
That one reads as, given gold stocks often don't track the gold price, would you say physical gold should be a part of your portfolio instead of gold stocks when hedging?
Absolutely. We are big fans of gold here at Life Sherpa, for all the reasons you've seen in those charts. We would prefer to hold physical gold, or at least an ETF that holds physical gold, rather than miners. As you say, miners don't track the gold price. There's a lot of corporate activity in that space, and you've got to understand where the mines fit on the cost curve to do that. So if you want to get the benefit of gold, which is really a function of a hedge, a safe harbor, and for people like us who live in commodity countries, so if you're South African, Canadian, or Australian, your currency tends to fall when global markets fall, and since gold is priced in US dollars, that tends to give you part of that hedge. So if you'd looked at those graphs for a US or UK investor, you would have got a slightly different picture. So it's partly the currency thing. And this is why you should be buying unhedged gold. There is a hedged gold ETF. I can't remember whose issues it, but unhedged physical gold. And our preference is not the Perth Mint one, given their relatively poor compliance track record. So that leaves one being gold, the former, the now Global X gold. Slightly higher fee than PM gold, but compliance problems are always a red flag when it comes to investing.
thanks to everyone for actually staying on. We did go quite over, and I really appreciate everyone taking in the time and joining us for these sessions. It is lovely to see everyone's messages and to talk to everyone on the side. We look forward to doing some more collaborations with you, Vince, in the future. Thank you so much for this amazing, amazing insights that you have just provided to everybody across a span of 5 months. Really, really good. And I am so excited to have done this with you. Thank you once again to everyone. A reminder, this webinar will be sent to you to your inbox if you have registered. And if not, please make sure to catch all of these live on, recordings on Sharesight's YouTube channel. Good night.
Thanks for coming.
Thanks for coming. Bye-bye.